markets are on a knife's edge, and we need to be very careful about where we're investing and know why we're investing. Fundamentals that need to get straightened out eventually. I mean, you just can't run zero interest rates forever. Be careful, be attentive, keep a little cash around, look for value, be very, very don't be buying and chasing stocks in this environment.
Hi, and welcome to Wealthion. I'm James Connor. Well, we saw a nice recovery in the global financial markets last week after that big sell-off the previous week, all because of the unwinding of that Japanese carry trade and weaker than expected unemployment numbers. We continue to see very weak numbers out of many discretionary companies like Disney and Airbnb, all of which are suggesting the consumer is under pressure. And after being up 20% on the year, the S&P is only up 12%. Does this volatility we are seeing in global markets mean we are at an inflection point in the economy? To help answer this question, my guest today is Jonathan Wellum of Rocklinc Investment Partners. And Rocklinc is a Wealthion endorsed financial advisor for Canadian investors. Jonathan, thank you very much for joining us today. How are things in Toronto?
Good to be with you again, James. Yeah, things are plodding along here in Toronto. A little bit cooler, and I can't believe we're getting closer to the end of the summertime. So I think time's moving on, but lots of excitement in the markets to talk about.
Yeah, it's hard to believe we are in the middle of August, but here we go. So much has happened since the last time you and I spoke. The markets got pounded on the back of Japan lifting interest rates, also a higher than expected unemployment number. And I want to start with Japan. And Japan lifted rates, and this impacted the Japanese carry trade, and it sent reverberations throughout the global markets. Japan's Nikkei was down 12% in one single day, the biggest drop since 1987. And over the course of 3 days, it was actually down 20%, which is quite hard to believe. But as an investor in North America, should we be concerned with what's happening in Japan, and should we be concerned with this Japanese carry trade?
Yes, I think we should be concerned because they're really dealing with global markets and global capital flows, and quite a bit of the money that carry trade comes back into our own markets in North America, and big funds, hedge funds, playing the carry trade game. And so I do think that we need to be very attuned to that, and it does tell us that the markets are on a knife's edge. And we need to be very careful about where we're investing and know why we're investing in certain stocks and certain businesses in certain areas. Wherever we are investing, we better have a pretty good handle on why and valuations and be pretty careful. I mean, I think as you point out, they were raising interest rates in Japan, but that's because interest rates there have been virtually zero for decades. I mean, it's a very difficult situation in Japan. They've had virtually no growth in that place, and so they're trying to build some equilibrium there, and they're making some adjustments. So that plays to the issue of global challenges in that market and around the world. So the carry trade, it's very important, but it also tells us behind that trade there are fundamentals that need to get straightened out eventually. I mean, you just can't run zero interest rates forever, and the Bank of Japan just can't keep buying up assets and printing yen. And so at some point, they're going to be forced into some sustainable financial arrangements in Japan. And if that occurs, then I think that carry trade goes away. Now, fortunately, a lot of people did unwind their carry trade, and according to the experts, probably about half of it has unwound. So that's probably a net good thing. That we aren't going to have as much, but we won't be as vulnerable as we were in the past to that trade. But it's still on, and I think we haven't seen the end of that yet.
And so, as I mentioned, the S&P is up 12% on the year, give or take. So it's been under quite a bit of pressure from its highs that we saw earlier this summer. But as this unwinding process goes on, they're going to have to be selling down whatever assets they own. A lot of speculation. They own a lot of these high beta names like NVIDIA and Apple and Microsoft, et cetera. But do you think we're going to see continued pressure in the S&P and the NASDAQ in the coming weeks as this trade gets unwound?
Yeah, I mean, even if the trade, stays where it is right now, and we don't have an addition to it, and a compounding of the problem, I think people do need to be focused on valuations. If anything, it's told us that there are certain stocks that have been the beneficiaries of large capital flows, whether it's because of indexing and ETFs and carry trades, that the Magnificent Seven, and there's more than just the Magnificent Seven. There's been a handful of companies that have been the beneficiaries of a lot of this capital, and they have pushed the market averages up. That's why we always like to talk to our clients and say, look at some of the smaller cap area, look at the Russell 2000. It gives you a much better indication of what's going on below the surface, if you will. Or if you extract the Magnificent Seven out of the S&P 500, you'll find out that those indexes haven't moved very much, and in some cases, there's a lot of stocks that are down. So I think again, it just warns us that valuations are stretched in certain areas, and if you're going into those areas now, be very, very cautious. And we can see the kind of volatility that can quickly erupt. And all of a sudden, we've got clients phoning us and saying, what's going on in the market? They're seeing all of this. But as we tell them, like, we don't have a lot of direct exposure to those Magnificent Seven. And we've got a lot of companies below the surface that are trading at pretty decent valuations. And they're not going to give you the wild ride. And so I think, again, it just forces everybody go back to fundamentals. Fundamentals will eventually, win the day. And if you're just trading on speculation or short-term moves, be very careful here. I think the trading that we saw with Warren Buffett is a good indication that maybe we should watch some of these fundamentals. He's certainly watching them.
Yeah, and I want to bring up Warren Buffett and his raising of capital. But before we do that, I want to talk about the unemployment rate now. And we saw an uptick in July. It was 4.3%, up from 4.1% the previous month. It bottomed at 3.5% in 2023. But are you concerned with this lift higher that we're seeing in the unemployment rate?
Yes, we are. And again, I think you have to put it in the backdrop of a massive increase in interest rates, large increase of the cost of capital for people to fund homes, inflation, energy costs have gone up. All of these things are impacting the marketplace, and it's inevitable that that's going to eventually translate into pressure on businesses, and businesses not having the same opportunity to employ as many people. And they're going to start doing some cutbacks in terms of employment. So this is not a surprise. In fact, this is what the Fed's been trying to do: put a stranglehold on the economy, slow it down, bring inflation down. But of course, the problem with that is that it gets us closer to a recession, or certainly a much slower growth in the economy. And we're going to see that in businesses. And so we want to be very careful the kind of companies that we're buying, because there's certain businesses and industries that will be much more vulnerable to increasing unemployment and pressure on the consumer.
And do you think the number is going to continue to increase? Like, is it going to move toward 5% before year end?
If they keep the rates fairly high where they're at now, given where inflation seems to be coming down, at least the rate of change, then yeah, I think the pressure for the unemployment to go up will continue to edge higher. And so, yeah, we would expect that to continue to edge higher. I mean, we're not investing based upon any massive changes in that. We're just really trying to find companies that can weather a more tougher economic environment. As I've also pointed out many times, and we've talked before, I mean, you've got so many of our governments running massive deficits. So, I mean, in the U.S., in some cases, every 120, 130 days, they're up another $1 trillion they've added to their deficit. So these kind of things can't continue either. And so I think we just want to be cautious going forward. There's a lot of pressure on the economy, a lot of pressure on government spending too, that it's going to have to at some point be reined in. And that's not going to be a good thing either.
So the next Fed meeting is in September, and the probability of them cutting 25 basis points is approaching 100%. And then there's also a high probability of them cutting 50 basis points. Do you think they're going to cut in September? And if so, by how much?
I'm always hesitant to make a lot of short-term prognostications, but our feeling is, if we just listen to the Fed itself, and they've been signaling this for some time, I'd be more inclined to see a 25 basis point cut. But they could do 50. I mean, that's not out of the question. They might want to just do 50 and then stand back until after the election, and get that out of the way, and then suggest that they're not political. It's hard to say. I mean, there was another Fed governor, was one of the Fed governors I was just reading this morning, saying that she's not inclined to drop the rates at all in September. So there's a real war going on here, and I think investors need to be prepared that the Fed might be slower than they think and might be behind the curve. Some people would argue right now that the Fed's a little behind the curve. So, but they seem to be signaling at least a 25 basis point cut, and the economy is getting softer, and they're going to have to be very careful with how they approach this. Where the signals are certainly, I think, giving them enough freedom and flexibility to drop at least 25.
Yes, and as you mentioned, there is a big concern that if they do cut, they're going to cut too early and inflation might tick up again. What are your thoughts on that?
Well, I think at this point, it's probably the argument is probably more geared to the fact that they might be behind rather than too fast. So I don't think that's really the issue. I mean, what's been prompting inflation, as we know, is just government spending and spending and spending. So you've got the fiscal situation really out of control, and then of course the monetary conditions. The Fed's trying to rein in inflation, but then so you got this war going on between monetary policy and fiscal policy. And but I think at the end of the day, the rates going up and inflation that's been caused has just pinched the consumer so much that the pressure is going to be to drop rates, even if inflation still is a little bit higher than they want. I think there's a lot of pressure to cut rates because there's so much debt out there, and they're concerned about the financing of the debt. We're seeing that now, even in the states, in the mortgage numbers and the housing market. We've already seen that in Canada. We're ahead of the curve on that situation in our country.
So let's talk about the consumer now, given that the consumer represents 70% of GDP. So whatever they do has a massive impact on the
Mhm.
economy. We've had weak numbers out of many companies, including Amazon, Nike, McDonald's, Starbucks, Airbnb, massive drop last week. But they're all suggesting that the consumer is pulling back. They're not spending money, especially when it comes to anything discretionary. What are your thoughts on this, and how much pressure do you think the consumer is feeling?
I think the consumers got a lot of pressure. We talked, I mean, just talking to our own clients here in Canada, but looking at, so the real people, we talk to real people. You talk about the pressure that they're experiencing, and then you look at the numbers on the companies, and it all reinforces one thing, that you can't double interest rates. In fact, more than double interest rates. You can't have 25, 30, 40, 50% inflation on all, core food items. You can't put the gas prices up. Insurance costs. I mean, it's just shocking how much insurance costs have gone up for virtually everything, your homes, for your autos, and so forth. And wages have not kept pace for most people. And so they're feeling the pinch. The money that the government's handed out during COVID is long gone. And if you look at the credit card companies and the indebtedness, people are now adding to their credit balances. So there's no question that the average consumer is under pressure, and that's going to be felt in businesses that are discretionary. The Airbnb one's very interesting because that's really a highly discretionary area where it's very quick. You just don't go anywhere. You're not going to rent a home. But again, we've Amazon. Amazon is probably one of the lowest cost places you can go and do some shopping. But they're also seeing those trends, and that's they're a massive barometer, if you will, of the broader consumer. And when they're saying things are a little tight for consumers, and they're seeing people, seeing those shifts in the spending patterns, you got to listen. Though that's probably the much better barometer than any of the government data that you're receiving.
So, as we mentioned earlier, you're a big follower of Warren Buffett and his style of investing, and he's been raising cash in the last few weeks. He sold down positions in Bank of America and also Apple. He's now sitting on a record amount of capital, $277 billion, which is kind of mind blowing. But what are your takeaways from this? And I know you can't really speak for him, but what do you think he's seeing? What's he concerned about?
Yeah, you have to, you really watch Buffett's actions. I mean, his words are important, and he is a tremendous teacher and instructor of investing over the years. If you read the books written by him, or if you attend his annual meetings, he's very, very thoughtful, and he's very expressive of his investment philosophy. Most importantly, though, watch what he does. And because often he'll be saying one thing and he might be doing something a little bit different, especially in the short run while he's positioning himself, because he didn't become one of the wealthiest men in the world and create a company that's worth almost $1 trillion by investing without being incredibly shrewd. And so, yeah, so when Warren Buffett is building up that kind of level of cash on his balance sheet, it tells us, I think, the broader market, be careful that Buffett is clearly lining up for opportunities, and opportunities for him means a down market or pressure in the market, a lot of volatility, where he can swoop in and buy up companies or positions in companies. And so I think the selling down of Apple, I mean, Apple in particular, it was a massive position. He still owns around 89, $90 billion in Apple. So it's still one of his largest positions. But he's sold down a lot, which means he's going to be paying tax. Buffett, even though he talks about tax fairness and all of that, he does not like to pay taxes if he doesn't have to. He's all about shareholder value. And so for him to make some of those decisions and to pay the tax, I think it tells us that he thinks it's better to have cash. The optionality of cash to be able to make a quick investment decision is going to be important for him. I suspect also, I mean, he's 90, he'll be 94 on the 30th of August. He was born the same month and year as my father, so I can keep track of him a little bit easier. But he'll be 94. And I think that knowing Buffett being as competitive as he is in terms of creating wealth, my guess is that he really wants to do one massive transaction, another big one before he leaves this world. And I think he sees the opportunity with the markets being expensive and a lot of vulnerabilities out there. Why not have some cash? He's getting 5%. Line it up, and if it goes his way, I think he'll be the first one to pull the trigger, and it could be a major transaction for the fellow. So I think it tells the broader market: be careful, be attentive, keep a little cash around, look for value, be very very don't be buying and chasing stocks in this environment.
And just to clarify, we don't know why he sold it. Maybe he sold it just to get his weighting down and not because of
Mhm.
something as he sees to be negative.
Right, absolutely, and it's still a large position. I mean, it's still probably about 10% of the value of his business. Or I'm just doing back of the envelope numbers in my mind, but so it's still a substantial position. And he probably made 5-6 times his money. He went back in 2016, so it's been an incredible investment for him, Apple. And he still speaks very highly of it. And he had talked about reducing some of it, but still maintaining a large position over time. So none of this is out of keeping with Buffett's approach and his discipline. But I think the other reality is that he hasn't been making a lot of investments for about a year and a half or so. So he has been building up cash, and he could see something on the horizon, a large transaction. You think of what he could buy with that money. Should be amazing size business, especially if he were prepared to put a little leverage on, not a lot, but just a little leverage. I mean, he could pick up an asset that's $400 or $500 billion. I mean, it's just his capacity to spend and to buy and to make investments is shocking. It's really something to watch.
So this is a nice segue into Rocklinc, your firm. And for those viewers who might not be familiar with Rocklinc, why don't we just discuss your investment approach and what your investment style is like?
Sure. I mean, I got involved back in the investment industry back in 1990. And as you pointed out, Warren Buffett is someone that I admire. And the individual I worked with for 19 years, Michael Lee Chin over at the ASE funds, one of the first things he said to me, Jonathan, is learn everything you can about Buffett, that investing ultimately is about buying great businesses and holding them for reasonable periods of time so you can defer taxes and compound tax deferred. And he said most people are trading too much and they don't focus enough on limited number of businesses. So that's something that has stuck with me and being ingrained in my DNA. And so that's what we do at Rocklinc. We look for a handful of companies. When I say handful, 20, 25 tops. So we don't look at the indexes. We don't look at sort of ETFs and so forth. We're going to look at a handful of businesses, and we generally will cover off 5 to 6 different industries because it is important, even when you're concentrating, to have reasonable diversification, because things can happen in any one industry. As you know, James, you can be surprised even by the best companies. And then we do a lot of due diligence. We talk to the companies, we run the numbers, we value these businesses, and then we build positions in a limited number of companies. And we think that's the best way to manage risk, because then you know the companies well, and you're also being very attuned to valuations. And that's the best way to actually perform well, because you can really zero in on companies that we think can grow at faster rates in the overall economy. And so, yeah, that's the way we approach it. Some people call it sort of value investing. When we look at the companies, we're typically looking at free cash flow valuations, present value of free cash flow going forward. But also there's some businesses where net asset value is very important, looking at the asset value, especially if you're looking at some of the royalty companies or real estate companies, infrastructure businesses. It's going to be a combination of cash flow plus the asset value of the business. And I think what I would really warn people at this current moment in time, look at the balance sheet, balance sheet, balance sheet, balance sheet. Make sure these companies are well funded, well structured debt, if they do have debt, and they have access to capital markets, and they've got that going out a number of years. They've been able to take advantage of the low rates over the last number of years, because that's one thing that can really come back and hurt a company if their balance sheet is stressed. And we go into a slow period, sales come down, they can't cut their expenses enough, and all of a sudden they start bleeding, and they have a highly leveraged situation. The equity value can disappear so quickly. So really watch the balance sheets when you've got so much debt out there, and companies are vulnerable. And if you can find companies with great balance sheets and great operators, then a tough market, a volatile market like we saw even last week, can really surface some great values. And it can also provide great management teams with opportunities to expand their business and buy competitors out. And so that's what we kind of look for when we're investing. Yeah. And we do all that and customize that for clients based upon their needs. So again, they come in and, not every, so we'll, find out clients' age and risk appetite and so forth, and then build portfolios around that for them.
So you mentioned you have a very selective or concentrated portfolio with 20 to 25 names. What would be the breakdown between Canada and the US just in terms of investments?
Yeah, I mean, I think the Canadian names, as we've talked about before, the majority of our Canadian names, they might be about 35% Canadian, and the rest would be US or European. Mostly US, because the US has got such depth and breadth, and most of them are great global companies. But even the US, even the Canadian companies we buy are typically Canadian based, but have significant US operations and even global operations. So I often will use the example of a Brookfield Corporation or something like that, which we own, the parent company, the top of the heap there, Brookfield Corp. I mean, that has assets all over the world, and yet it's a Canadian-based company, so to speak. And so that's an example. Or even some of the royalty companies. We own some wheat and precious metals, for example. Well, that has royalties all around the world, and it's U.S. dollar denominated because it's really pricing mostly silver and gold royalties. And so, so we have the exposure in Canada, but we find that most of our businesses are making money in many different jurisdictions around the world, which is what we prefer. We prefer that diversification in the business model itself.
And where are you allocating capital now? And I know every client is different depending on age and risk tolerance and many other factors, but what sectors are you investing in? And maybe you can go through some names.
Yeah, so I just mentioned infrastructure. So we have the Brookfield Corporation. We like hard assets, particularly if they're non-regulated. So you can get involved in a lot of infrastructure or utility type businesses, but if they're heavily regulated, that's a concern for growth, and making adjustments to the cost of capital is tough. So we like, say, Brookfield Corp. We also own a couple of their subsidiaries, Brookfield Infrastructure and Brookfield Renewable, which we think are very well run. They also pay great dividends, and they're not expensive. I mean, they've been impacted by the massive rise in interest rates. So the pricing of those companies, we think, is actually they're quite inexpensive at this point, and they continue to grow at. We just had their earnings 10, 11, 12% growth in those businesses. So they're really good at recycling and growing their assets. In the precious metals, as I mentioned, we own some of the royalty companies. So we have Wheaton Precious Metals, a Cisco Royalty, some Franco-Nevada. Again, we like those companies because they're really investment bankers to the miners, but they get all the upside of gold and silver, and some have copper and nickel and a few other base metals mixed in there. So we like those businesses, and some of those companies, again, are not ridiculously expensive. Some are a little dearer than others. And then in non-bank financials, we have a number of non-bank financials, and in there I'd put a company that is sort of a non-bank financial / insurance, Trisura. We like Trisura, which does a lot of insurance brokerage. Again, a spin out of the Brookfield assets. We also have Burford Capital, which we just been picking away and adding recently. That's a non-bank financial, provides financing for litigation. A really intriguing area, and very undervalued in terms of that business model. And then we have some consumer staples, some Church and Dwight, really boring, Arm & Hammer and Trojan condoms, and just very basic things that people buy. And a real good leader in terms of value orientation. And so there's some examples of some of the businesses that we don't. Technology also, you have to have some money in technology, and so we own a number of tech companies, including Roper, which is in software, Autodesk, Adobe, We've owned Amazon. We still own Amazon. We like Amazon. We bought a lot, especially when it got hammered back in 2022, early 2023. We were shocked that it dropped about 40%, and then quickly went back up 80%. But we like that business model, and yeah, so technology is another area that we constantly are trying to look for, because technology really has become basic infrastructure, essential businesses. You can't get rid of them. They have tremendous moats around them, and that's what we really like. And they're also huge free cash flow generators.
Now, I'm surprised you didn't mention banks, Canadian banks or U.S. banks. Do you have any exposure there?
We don't have any, well, I shouldn't say we don't have any. We have virtually no exposure. We have some clients that have come in with large capital gains and they have some bank stocks, but we don't have it as a fundamental position in terms of our 2025 stocks currently. That's not because we think the banks are just going to blow up or are a problem. We just think that going forward with the level of debt and mortgage debt out there, and problems in a number, commercial real estate and so forth, that they're just going to have a tough time over the next number of years. And we would prefer to not have any exposure there. We just don't see a lot of upside, a lot of growth, and potentially, yeah, we could see some problems if the proverbial stuff hits the fan. That's not our base case, but we really don't see a tremendous amount of upside. I think as the banks, start to report, I think they'll be reporting mediocre and average numbers, and if they're making money, it'll just be on trading. But on their basic loan books, I think there'll be some pressure. There'll be some tension there, and for us, we just don't need to be there. We're not investing off the index.
Yes, it will be interesting to see what kind of commentary they have to say about the Canadian consumer and also loan loss provisions, because those loan loss provisions have been moving up here in the last few quarters.
Yes, and we watched the amortization periods, and the amortization periods for a while actually were really sneaking up to 35 years. In some of the banks, not all of them, had about 18 to 20% of the loan book had amortization periods up to 35 years in Canada. For some of the new buyers, we saw Canada, our Christy Friedland, our fearless finance minister, came out with this push for 30-year amortization, which again just straps people with a tremendous amount of interest costs. And that's not really the solution. The solution is to get inflation down and build more homes and get rid of regulations and free up the market. But just adding adding to the amortization period, adding more interest to people's costs is not a long-term solution. I think that that makes the banks and financial institutions actually more vulnerable, not safer.
Now, you made mention of the fact that you do have exposure to gold through royalty companies. What about, do you have any direct ownership in physical gold or any gold miners?
We do have a little bit in gold miners. Our largest holding in the gold miners is Agnico Eagle, and they have also done very well this year. And that's because the management of the company, I think, is very astute. They're very careful allocators. Sean Boyd's done an excellent job over many, many years. They also have tremendous mines in reasonably safe jurisdictions. You include Canada as a reasonably safe jurisdiction, depending on what government we have. So we do have there. We also have a little bit in a couple of the silver miners, because some of our investors do like to have a little silver exposure directly, and I'm fine with that. But we typically buy, the Silver Crest. We'll buy some of the best silver companies, but they can give investors a lot of juice. And so, yeah, so we have a little bit in terms of miners, and we have a little bit physical. But if we're going to buy physical, we have some investors who want to buy physical. Many of them will do that on their own and go and buy it directly, or typically we'll use one of the Sprott physical trusts, because we like those trusts. They're all backed by physical gold. There's no derivatives, and so they're getting what they're actually purchasing. So we like the Sprott physical trust, whether it's silver or gold, and we think those are one way of going also. But those would be smaller positions. The lion's share of our exposure to silver and gold would be through the royalty companies. Yeah.
So, Jonathan, the first half of the year was exceptional in terms of returns in the markets, but the second half, there seems to be a lot of increasing volatility, okay? We have still uncertainty about the U.S. economy and whether or not it's going into recession. We have uncertainty about the Fed and whether or not they're going to cut rates. We have the U.S. election coming up. There's a lot of uncertainties, right? And that's leading to all this volatility in the markets. But what advice are you giving to your investors on how to proceed going forward?
Focus on the companies and on the businesses. Focus on your investments. Know what you own, know why you own them, and know what price you're prepared to own them at, and what price you get out of them at. And so I think it's really double down on your knowledge and where you're investing. There, again, overall, the market is not inexpensive, and there are many challenges ahead that shouldn't keep you from investing, but it should focus your attention on buying good quality at good prices, reasonable prices. And that's what we're telling our investors. Simply, when we went through the volatile period, last week, it was just last week. It's amazing how fast things are moving in the marketplace. That was, again, our message. We weren't not overly concerned in one sense. You're always watching the market. You can't say you're not concerned when you see the VIX go up 140% in one day, and things like that. But what gives us solace and strength is the businesses that we own are largely irreplaceable businesses. These are essential franchises. They are amazing companies. They have powerful balance sheets, and they're trading at what we believe is reasonable valuations. Yes, they can come down, but they shouldn't be coming down, anywhere near as much as, some high flying companies, or companies that are just, storied companies and not backed by tremendous assets and balance sheets. And that's what we constantly tell our investors, that you have to be prepared for volatility. If you are not prepared for a 40 to 50% drawdown in your stocks, you really should not be buying stocks. If you need that money in 6 months, a year, or even 2 years to buy a house, be very careful. You should not be buying, volatile securities. And so again, as part of that is just wisdom and asset allocation and knowing what you own. That's really what we're trying to emphasize to our investors constantly. But the thing is, if you go through a period where the market goes up, as you know, James, and it continues to go up, and all the averages are going up, people just get lulled into complacency so quickly, even though they tell themselves they'll never do it again. They'll never behave like they did in 2000. They'll never behave like they did in 2008. And soon as the market gets choppy, you're on the phone with people, and they want to pull everything out immediately. And you're just like, you're back to square one again. And so our message constantly is the same: be careful, know what you own, have proper asset allocation, make sure that if you're going to need the money in the next little while, you're not putting it into high risk, securities, or securities that are going to be volatile, and be patient. And don't just have a knee-jerk reaction. I think it's Buffett that says, if you're taking your cues from the market, if that's where you're taking your cues on how you're going to act, you're going to get yourself into a lot of trouble. You must master the market. Don't let the market master you.
Well, Jonathan, always great insights. And as we wrap up, if someone would like to learn more about you and your firm Rocklinc, where can they go?
Our website is terrific. So rocklinc.com, and that's link with a C. So rocklinc.com. If you do put info in front of that, info at rocklinc.com, that'll come right to a couple of our key guys here, and we respond to you. And our phone number, 905-631-5462, which is link, depending if you have that on your dial, on your what you're inputting your numbers on. And any of the extensions, you'll get a hold of one of our professionals, and we would love to talk to you. And as I think, as you emphasized with Wealthion, there's no charge. We're more than glad to look at your financial situation. No pressure. Come on in. We'll go through your existing investments, give you our opinion on them, and what we will do in terms of investing. And we welcome anybody who wants to have a chat and come in. Please, by all means, reach out to us. We'd love to hear from you.
Well, once again, Jonathan, thank you.
Thank you very much, James.
Well, I hope you enjoyed that discussion with Jonathan Wellum, and it gave you some insights on what to expect in the financial markets in the coming days and weeks. We all need help when it comes to planning and preparing for our financial future. And if you have a financial advisor and you're happy with him or her, then great, stick with them. But if you don't, or maybe you want a second opinion, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. It's a free service that Wealthion offers to all of its viewers. You can find out more at wealthion.com. Thank you very much for joining us today, and I look forward to seeing you again soon.